Good morning. Welcome to the investment meeting of the Teachers Retirement Board for December 7th, 2023. I'll start by calling the roll. Kevin Lowe.
Present. Representing Mayor Adams.
Thomas Brown.
Present. Patricia, good morning.
Good morning. Gregory Faulkner or Anthony Giordano. Allison Hirsch.
Present, representing Controller Brad Mander.
David Gazansky.
Present.
Victoria Lee.
Present.
We have a quorum. I'll turn it over to the chair.
Great, thank you. Good morning, everybody. Good morning.
Good morning.
Online. Guess we'll start off with the passport funds, third quarter 2023 performance review by Roker Time.
Great, and I will attempt to share my screen as I'm pulling that up, but for anyone following along in the materials, I'm going to ask you to flip ahead to slide 26 on convenience.
It has the quirk today, so we hit the path, will come up. Yeah, something. So we're working. Okay, so we should be right there.
So I think, as everyone will recall from the last meeting, we did discuss what was a more challenged quarter from market performance standpoint during the third quarter. And what we did want to just very briefly recap were the returns for the passport funds during that time period, which I now have up on the screen. So you can see that for the quarter, markets sold off a little over 3% here in the US and abroad, equity markets that is, and the diversified equity fund was also down about 3.5%. But what we also saw with the strong market environment coming into the first half of this year, fairly strong still year-to-date returns for the calendar year-to-date time period through September. So the diversified equity fund up over 10%. And then if you look over the trailing 12-month period, again, with that strong market rebound coming out of the COVID period, markets up over 20% with some value add over the trailing 1 and 3 year time period for the diversified equity fund. You can see a lot of that contribution is coming, as you would expect, from the actively managed component of the US equity composite, as well as the international equity composite. Over the trailing 3 years, about 1% outperformance from the active manager composite, and about 60 basis points of net outperformance for the international composite. So I think after a number of changes made to that fund, or within that fund a few years ago, we're starting to see the benefits of those changes play out in the relative performance. For the balanced fund, again, a down quarter, but fairly strong returns for that fund when we look for the year-to-date, up nearly 4%, and on trailing 1 year and 3 year time periods, up over 7%, 1% respectively. The international equity fund down about 4.7% for the third quarter. Again, very strong long-term returns with international markets also up over 21%. This fund was up over 22%, so we will definitely take that. The sustainable equity fund, following growth stocks, which were down about 3% during the month. You can see that fund was down about 2.5%, so some relative outperformance there. Longer term, a little bit more underperformance for that 1 year time period, and up over 7% over 3 years. And then for the index funds, as you'd expect, those funds track their benchmarks very closely. So we just wanted to recap that for everyone. Would you like us to move to October?
Sure. Any questions first for Mike or Amanda? Great. So we can move to the passport funds for October 2023 performance review. Good month, right? No.
You want to wait for November for the better numbers. Yeah.
To wait a whole month.
So the month of October, unfortunately, was negative pretty much across the board. Within equities, we saw US equities faring a little bit better than non-US, and certainly better than emerging markets, which were the more challenged area of the equity markets. More defensive areas like utilities fared better than energy, which was one of the worst performing sectors for the month of October. On the fixed income side of things, we have seen most of the major central banks at or near peak rates, and only likely to raise further if we see surprise on the upside in terms of either growth or inflation numbers. We also saw treasury yields continuing to rise. The 10-year popped up above 5% for the first time since 2007 during the month of October. In terms of the passport funds, the diversified equity fund, which does have over $15 billion in assets, had a return of about -3% for the month of October. And within that, the passive US equity at -2.6% was the best performing segment of the diversified equity fund, with the active and international composites down around 3.5% and -4% for the month. The balanced fund was your best performing option for the month. It is more conservatively allocated, which was down around 1% for the month of October. And that international equity fund, as we talked about, was the more challenged area of the equity markets during October, down a little over 4%, and trailing that benchmark by just around 15 basis points. The Sustainable Equity Fund is a growth-oriented fund, did trail a little bit versus its benchmark for the month. Given some of that growth orientation, we have continued to see very style-driven markets, either in favor of growth or value throughout 2023. And so that fund was a little bit challenged relative to the benchmark based on style. The passive funds at the bottom of the page are tracking their benchmarks, as we would expect. A little bit of tracking error for the international fund, partly due to timing of cash flows. I'll pause there to see if there's any questions on October results.
Any questions for Amanda? Thank you, Amanda. Now we move to November 2020.
The highlight of.
Who gets to do those? I'll do those.
I might even do those.
Tom volunteers for November.
I think I heard November described as quite a year for the markets. So
Good.
we'll take what we can get, and all the unfortunate numbers we looked at for the third quarter from a negative perspective were completely reversed in the month of November. So the equity markets in the US were up over 9%. I think what I heard was that might have been the third strongest month for equity markets in the US since the global financial crisis. We saw the 10-year Treasury yield move down by about 60 basis points in the month.
Yeah.
That was the largest monthly move since July 2021. And in all else equal, we've continued to see a lot of volatility in Treasury yields this year. So it was a fairly impressive month across markets. You can see on this page, if you look down the page for the month, very strong. I noted the 9% return for US equity markets. Non-US equity markets also did quite well. Emerging markets standing out as maybe I'll say the laggard, still up 8% for the month. So it was very strong across the board. If you're looking at the global market composite at the top of the page for the diversified equity fund, you can see that benchmark was up about 9.3% for the month. That brought the fiscal year return back to positive, right around 2.5%. Calendar year to date, that benchmark's up over 17%. So we will take the exuberance that came with comments from the some FOMC members around the moderation in inflation that they're seeing, moderation in wage growth.
I'm sorry,
as
Mike,
well.
you said the year to date or fiscal year to date was 1.2?
2.5%.
2.5
for the diversified equity funds benchmark. Yep.
And the year to date?
Calendar year to date, 17.2%. again, I think a lot of the market performance we saw really being driven by the comments we heard from the Fed acknowledging moderation in inflation, wage growth, all of that leading to investors being a little bit more exuberant around the potential for interest rate cuts in 2024. The market, I think last I saw this week, was pricing in cuts as early as second quarter. We're
May.
yeah, we're saying probably later in the year in terms of our outlook. We also do think there is still, albeit modest, but still a chance of recession if you look out over the next year. But again, probably still shallow if that. But that again is really centered around the possibility for shocks related to if we do see, kind of reversals in inflation, that would probably cause the Fed to maybe not cut rates. At this point, it doesn't feel like there's a likelihood that they'll increase rates, but if we start to see some of the numbers, which can drive a very data-dependent Fed at this point, change the story, we could see a little bit more stress. We are seeing earnings slowing a little bit as well. So something else we're thinking about looking out into 2024 on. I'm sure Steve has some comments that he'll make as well. So I don't want to belabor it, but it was a good month and we'll take it. And so far, December is off to a more kind of flat look for equity.
5 days.
Yeah, I don't even want to make annual predictions, let alone monthly.
Great, thank you, Mike. Any questions for Michael or Amanda? Great. Let the record show that we have Effie Zachary, who just joined us. Thank you. Welcome, Effie.
Thank you. Good morning.
Good morning. So we move on to the pension fund performance update quarterly presentation. Steve, I guess you'll take that one.
Yes.
Thank you.
Mr. Chair.
Thank you.
So I've been a little under the weather lately, but I feel on top of my game today. And I told Kate to try to keep up, so it says 30 minutes update. It won't be 30 minutes, but there is a lot to talk about.
An hour and a half.
It'll feel like an hour and a half, it'll be 15 minutes. Kate, you go to the first slide, please. Obviously, everyone's been focused, laser focused on inflation in the last year and a half. US and global inflation rates have obviously declined. This decline has caused markets to price in or assume that rate hikes are done. That's both here and abroad. And bond prices have significantly rallied more recently, as Michael and Amanda talked about, and yields have come down commensurately. And I'll talk a little bit more about where we are today from a rate environment. On the next slide, inflation, you can see as a reminder, CPI in white actually peaked at 9.1% in June of 2022. It's now at about 3.25%, so it's really come down significantly. Core PCE deflator has been a little more sticky in the mid threes, but expectations are for them to continue to move lower. On the next slide, actually, the European Union surprised on the downside with inflation. Their most recent print showed inflation coming in around 2.5%, which was below the estimate of 3.8%. So some good news there. But again, a general decline in inflation levels around the world. I should also say that this has been a really unusual time. A lot of people look back at history and say, well, where are we in the market cycle? The market cycle analysis kind of goes out the window because we're coming off of a pandemic, which is a very unusual time. And I think that is evidence of where we are. On the next slide, from an employment standpoint, employment growth has slowed in line with Fed expectations recently here in the States. If you remember last year, we had growth in employment of close to 300,000 jobs per month. It's actually slowed nicely now. In the last month, in October, it came in at around 150,000 jobs created. The unemployment rate in the States is 3.9%, still below 4%, which is quite remarkable given the amount of tightening we've seen. And this week, tomorrow, we actually have a non-farm payroll report for November. And the market consensus is for 180,000 jobs created. Some of that has to do with the strike and the settlement of the strike, which is higher than we saw in October. But again, expecting to 3.9% unemployment tomorrow. Yeah, at 8:30 in the morning. Yeah, we'll be watching. On the next slide, just again, a electoral representation where we are. Came down a little bit in terms of the labor force participation rate. We're still not where we were pre-pandemic, but again, it's a good story all around. And again, slowing commensurately with Fed expectations that should hopefully keep them on pause from rate hike cycles. On the next slide, a quick look at where we are, where we've come, and what the expectations are. The consensus forecasts are for us to continue to see a decline in employment growth in the states. Again, the interest rate hikes that operate with a long and variable lag, and that is expected to be reflected in the coming months as the employment rate slows down. Next slide. U.S. economic growth, third quarter U.S. economic growth was actually fairly robust, came in close to 5%. Actually was forecasted to come in as high as 5.8% by the Atlanta Fed. So those are really remarkable numbers. And the U.S. is outperforming expectations for growth relative to China. On the next slide, a look at where we are, and you can see on the far right-hand side where the green line, which is China, and the red line, which is the U.S., touch and converge around 5%. Growth has actually been really challenged in China. I'll talk a little bit more about that in a moment, but it's been really quite robust in the States, again, perhaps potentially, specifically given where we are in the hiking cycle. On the next slide, as Mike and Amanda talked about, a lot of this has to do with interest rates. So the US, the UK, the ECB, and Japan, and I'll qualify that in a moment, rates have all been on hold recently. Expectations are for the next moves to potentially be lower, as Mike said. I believe there's an 83% chance of the cut being priced in for May. I agree with Mike. I do think that's premature. And the expectations are that perhaps you'll see the ECB cut rates even earlier. And the market's starting to price in declines. There are 5 rate cuts in 2024 to begin in April. Again, I think that's probably perhaps too optimistic. There was news overnight about Japan. So Japan is still the one holdout where they continue to have negative official rates. On the next slide, you can see that on the bottom. They still have negative 10 basis point official rates. But there was some commentary overnight that they may actually adjust their rate policy when they meet on the 18th and 19th of this month. The Fed meets next Wednesday, and the expectation is for no change in interest rates. But you can see where you've got the Federal Reserve, the Bank of England, and the ECB. Again, the staircases on the far right show those rate hikes that we've had since really March of 2022. And Japan has been kind of an outlier, but they've made some tweaks to their yield curve control. And again, perhaps they will raise rates at some point later this month. On the next slide, just a look at where we were in November. Bond prices increasing yields came down significantly. We saw significant retail flows into corporate debt, both high yield and investment grade, driving spreads lower. I'll show you a slide on that in a moment. And we've had huge flows in investor interest in private credit, which I think is certainly consistent with our view in terms of the value that private credit options present these days. Maybe skip the next slide, Kate, and go right to the U.S. Treasury yield history. You can see where we are. Far right-hand side in white, 478 is where we were on November 27th on 2-year yields. As of last night, they were actually 2s were at 460. And in green, we see the 10-year yields at 435. They actually touched 410 yesterday. Again, Mike talked about a 60 basis point decline through November, which is correct. But where we are now is they're down almost fully 90% from the peak, is slightly over 5% earlier this year. So a huge decline and a lot of volatility in bond prices and yields. On the next slide, a quick look at spreads. On the top, you can see high yield spreads, and then white below that, investment grade spreads. They're both trading below their median, which represents perhaps a less compelling argument to reallocate money into those areas right now. Again, we continue to expect volatility around those spreads. But a lot of that has to do with retail flows into investment grade and non-investment grade product, as well as typical insurance company inflows into the sector. On the next slide, recently both stocks and bonds have rallied, which you heard that recurring theme, and Mike had the privilege of going through November. For November, the public market 60-40 split, the portfolio actually achieved a 7.6% return. And to echo Mike's comment, it's a great year in 1 month, great returns for the year in 1 month. But over the last year, for the full year 2023, the 60-40 portfolio has generated a return of 11%, which is significant. On the next slide, not to beat a dead horse here, but yeah, obviously third quarter returns in public sectors were challenged. I like to highlight high yield, which has half the duration exposure of investment grade corporates and wider credit spreads. So there's more carry, more coupon. And you can see that reflecting the fact that there was a positive, albeit a small positive performance for a challenging quarter. On the next slide, we'll look at world equity markets. The Russell 3000 year to date is delivered almost 18% returns, 17.7%. But you can see all manner of index on the upper side. Dow's up 7%, S&P 500 up 18, almost 19%, and NASDAQ fully 36%. I'll comment a little bit more on that in a moment. European stocks have actually performed very, very strongly, coming off of a challenging 2022 as well year to date. Asia has been a little more challenged, particularly given the weakness we've seen in China. But we should note that Japan is a little bit of an outlier in terms of their significant outperformance of 28% up year to date. The bottom on the last line in the bottom, number 41, that's the Bloomberg World Index that comprises fully 85% of the market capitalization around the world, and that's up 14% year to date. On the next slide, world bond markets, sovereign yields in the US and Asia are higher. You can see that on the far right hand side. US at the time of the snapshot, we had a 4.34 10-year yield. It started the year at 3.88%. That's to say we're up 48.6 basis points for the year. Europe has seen more of a rally. Again, it has to do more with the sluggishness of economic growth there. And Japan and Asia, we've seen higher yields associated with growth in those markets, notwithstanding the fact that China, on the very, very bottom, has seen a contraction in sovereign 10-year yields. Maybe skip ahead to recent news. Kate, a couple of things. I talked about the Chinese economy. It has been very challenged, particularly by the property market there. The shadow banking system, I don't know if you read the Wall Street Journal, there's an article yesterday that is significantly struggling with off-balance sheet or non-bank debt of anywhere between $7 and $11 trillion. Again, a lot of that's tied to the property market. Moody's actually placed China on negative credit watch on Tuesday, and the expectation being that the banks will likely, Chinese government will likely step in to provide some level of support for local government debt that's been issued and in numbers in the trillions. A couple other things of note: Sam Bankman-Fried is heading to prison, who was the former brainchild behind FX Connect. I'm sure we're all sorry about that. As the former chairman and CEO of Binance. And lastly, we've seen some disruption in OpenAI. I don't know if you followed the shenanigans in the boardroom last week of the drama, but Sam Altman had left, was going to Microsoft and came back. They restructured the board, where they put Larry Summers is actually now one of the new board members, which I think is remarkable, and in a positive way. And yesterday, Elon Musk announced the fact that he was coming out with his own AI solution. But a lot of people don't remember or realize this. OpenAI was actually initially co-founded by Elon Musk with $1 billion commitment of his own money. And there's a lot of movement there in terms of what they're doing at SpaceX, automated cars at Tesla, and neural implants at Neurologic.
He's been quiet.
Yeah, I just finished his book, obviously, so you just got the snapshot. Which frankly, I don't think I'd ever read a history book about someone that's 10 years younger than I am, still alive. But Walter Isaacson's one of my favorite authors, and it's just a really interesting book in terms of. I'm not a big Elon Musk fan, but it was a worthwhile read. On the next slide, food for thought, and I actually love this segment. And you can see over the course of time where we've actually seen asset class bubbles develop. Starting with gold back in the 1970s. I had to get on ChatGPT this morning to figure out what was the peak of gold back in the 70s, which was $850 a troy ounce. It's over almost $2,000 a troy ounce now. A huge run up in Japanese stocks. If you remember, they peaked in 1989. The Russian phenom as well after the Cold War, where those prices ran up and then came straight back down. The tech bubble we saw in 1998, 99, which crashed 2000, 2001. Obviously, very challenging time there, but that market recovered and the internet is the real thing. And you can look all the way to the far right-hand side where it actually has AI. I still think AI is very much a transformational technology that we all should keep our eyes on, but prices have really kind of run up in certain of those stocks, and I'll touch on that. Actually, in the next slide, Kate. The next slide actually distinguishes the S&P 500 returns relative to, well, the top 7 stocks relative to the other 493. This is referred to as the Magnificent Seven, which has really dominated S&P 500 performance with average returns at slightly over 80% year to date, which is really extraordinary. And for those, just as a reminder, those stocks, those 7 stocks are Apple, Microsoft, NVIDIA, which is the chip maker behind AI, Amazon, Meta, or formerly known as Facebook, Tesla, and Alphabet, or Google. So interesting.
Tesla.
Yeah. More food for thought on the next slide, perhaps a little more negative. The default cycle has started. You can see on the far right-hand side where default rates have kind of moved up in terms of loans and high yield bonds. They're not at extraordinary levels, but they are inching higher. On the next slide, we can also see credit card delinquency rates are rising, and the cohorts there by age groups. As people kind of spent through their COVID dollars and starting to put more on their credit cards. These are serious delinquencies that are beyond 90 days. Similar story in the next slide regarding auto loans. Serious delinquencies, again, are edging higher. So not all is well in the economy, and that's another reason why we expect to see growth slow. Earnings perhaps be a little more challenged in the first part of next year. On the next slide, also rapid decline in bank lending. You can see on the far right-hand side, bank lending is now contracted. A lot of this has to do with the regional bank challenges we saw in March, April, and May, and the pullback associated with the protection of balance sheets and less of an ability or willingness to lend on the part of regional banks. This rapid decline in bank lending will constrain U.S. economic growth. Again, another reason why we expect the economy to slow, and at some point the Fed to start reducing rates, probably in the second half, Mike, of 2024. I'd say the other thing meaningful about this slide is that non-bank lenders have stepped in and sort of being much more relevant in terms of filling that gap of lending as the banks pull back. On the next slide, and I've done a little headwork, I found this interesting. This is the growth of public markets and private markets over the past decade. The global fixed income market outstanding today is about 136 trillion. 42 trillion of that has grown. Issuance has grown over the last 10 years. That's about a 44% increase. Public equities, about $110 trillion of outstandings, which is up about 46% from where it was 10 years ago. I don't have good data on the banking sector, I'm afraid, but more importantly, I think for me on the far right-hand side, you can see that there's been an additional $8 trillion in growth of outstandings in the private capital markets. And that's now about 40 trillion plus outstanding, which is about a 25% increase. So I still think it's very prudent to continue reallocating money from public markets into privates. Next slide. This is really interesting to me because there's started to be more of an awareness. The market was very focused on macro trends in the economy and the Fed policy. There was a little bit of a pivot in October when bonds sold off really quite significantly before the rally in November. It had more to do with fiscal concerns and the amount of debt that we're issuing. And I've said, I think at prior meetings that we're expecting to see on average auction for U.S. Treasury debt to increase 24% in 2024 alone. So the question is, who will the marginal buyers be? And what this slide indicates is that perhaps it will not be China, it likely won't be Japan either, given the currency hedge, the cost of the currency hedge. But again, this reflects since 2021, a $300 billion reduction in terms of holdings by Chinese entities. So again, some concerns about market technicals as issuance goes up and perhaps demand is weakened by central banks abroad. But again, more eyes will be, I believe, on fiscal as well as macro concerns in the future. And I think the last slide I have in terms of food for thought, and again, not to beat a dead horse here, but it gets back to China and the Chinese consumer confidence being in a next slide, Kate, please. Thanks, Kate. On the far right-hand side, you can see that consumer confidence has really plunged recently in China as they have come out of COVID. It hasn't been as robust a recovery as it would have been expected. This is constraining growth in the world's second largest economy. Again, it's hard to draw a parallel between the Chinese economy and the US. US being larger is a more developed economy. The average earnings in the US, I believe, is about $76,000 per annum per household, versus in China, it's around 13,000. So kind of an apples to orange comparison, but China is an engine for growth for the global economy, and the fact that it is weakened and not performing to expectation has implications for global growth.
We've seen this too. We were looking at household deposits, so consumers, the money they're holding in their savings accounts within China the trend has been significantly increasing in recent years, indicating low consumer confidence in China as well.
The savings rate is going up.
They're keeping more money in the bank. Not spending.
There was an article in the journal today that actually talked about they're putting it into a lot of the non-bank, the shadow banking entities that somehow have attractive return streams that are tied to the property market. There's been 2 defaults in the last 2 months in China, which is something that the Chinese government are very concerned about because of China, the shadow banking system in China is just enormous and it's unregulated. And I even saw in the article the words Lehman moment came up. So I wouldn't be that dramatic, but it is something that bears.
Steve, I'm sorry, did you say the average salary in the United States for family was $76,000?
Yeah.
So was that the median?
It's the median. And in China, it's 13,000. So a little bit of an apples.
Median salary is $77,000.
Yeah.
For family, for a two worker household?
I believe so, yeah.
That makes more sense.
Yeah. I think the average per individual is closer to something less than 50.
I was gonna say.
Getting to performance, perhaps more importantly. So Dan Haas, who is actually on both the risk team and reports also into Lynn Fleischman, our Chief Operating Officer, has been doing some great work. Dan's charged with trying to provide more of an analytical rigor and to do some wonderful things on reporting. So Dan's been quite creative. The first 2 slides are things that he put together. Kate, if you wouldn't mind going one more slide, please. Yep, so this is kind of a different look at performance. Again, for the 3rd quarter of this year was very challenging. Total plan return, which includes private assets down 2.4%. Most of that largely driven by the sell-off that Amanda very appropriately and accurately talked about in the 3rd quarter. So some challenging times, but again, tend to focus on longer term results. Longer term, I don't think it's 5 years, probably 10, 15, 20 years.
Can I ask you a question about this slide?
Sure.
The TRS policy return is like the benchmark return?
It's a strategic asset allocation.
Like what we anticipate the return should be? Or like why is the plan return and the policy return different?
Well, the policy return should be 7%, but this, we're not at all,
Oh, it's,
yeah, it
oh,
has
I
to do with
guess
the
I'm
strategic asset
confused.
allocation.
I guess it looks like
I think that's the benchmark.
it's the benchmark, not the
Strategic
policy, because it's at over,
Yes.
it's like at 10.5,
Yeah,
so it's
yeah,
not 7, okay, that's fine.
This doesn't have November.
This doesn't have
Not November,
November.
this only goes
right.
to September.
This is September, so thank you.
It doesn't even have October.
And the median fund Sorry, median fund taxes like median other public pension.
Yeah,
funds?
and there's a significantly higher allocation typically to
private.
private assets.
Yeah. So for the 3-year and 5-year, we're doing 3.
Yeah, 1 year, 3 year, 5 year, again, positive returns pretty much across the board, but again, you have a 7% hurdle rate, so I think if you look at longer, you can see that. And actually, I think,
That 7%, if you go back.
yeah, we do, I think we get to that in a few minutes, it's common.
I like how strategically you put these slides.
Yeah.
Good.
On the next slide, Kate, if you would, another Dan Haas production, just looking at $1,000 invested in the TRS portfolio versus the 7% return target, which is compounded. So that black line is the 7% target. It reflects where we are, particularly shows the sell-off we saw in 2022 and the repair that we saw up through middle part of the summer and the sell-off again in the latter part of Q3. But and this slide will be more meaningful as time progresses. On the next slide, a look at the teachers' net public market returns by strategy. Again, a tough market for 3 months. See both equity and fixed income sold off. Again, high yield being a wonderful story with half the duration exposure is investment grade and coupon, as I mentioned. Cash is also king. Those 3-month returns, if you annualize them, probably closer to 6%. They probably should be around 5.60 right now, 5.30 right now. But again, just an interesting way to look at things. And again, focusing on the long term. I think I have some longer term notes. I do in a moment. On the next slide, a look at teachers' public market excess returns. Here, a couple things stand out to me. Firstly, the world ex-US, that's developed market ex-US, underperformed, generated a negative return of a little over 3%, 307 basis points relative to its benchmark. That's driven mostly by 2 of the managers that tend to be a little more aggressive and thoughtful in their stock selection. Again, it was a challenging quarter, but Bailey Gifford and Walter Scott actually underperformed the benchmarks anywhere between 900 basis points and 600 basis points. Again, that's why that reflects negative performance there and pull down in terms of overall returns. On the next slide, I'll look at teachers' net private manager returns, which is, I think, a better story. On the far left-hand side, you can see in 1 year, pretty much green across the board. Private real estate core being the exception. Those are June to June mark-to-markets. And again, that sector, the core investments have been a little more challenged. But again, if you look at, to your point, Tom, about longer term performance, this is just private markets. But again, it does focus on 10-year and since inception returns that are all positive.
Still good.
Yeah. On the next slide, a look at teachers' private market excess returns. And this is, I pushed back on a little bit because I know private equity has been a little bit challenged in terms of exits and some valuation issues. But the 1 year excess return, so apples to apples, even though it says as of June 30th, those are June to June returns for our private equity book, as well as the Russell 3000. The private equity book the positions actually returned a positive return of 6.4 basis points. And again, to talk more about where Russell 3000 was in the first half of the year, it was up fully 18.9%. So about a 1,200 basis point underperformance relative to its public market equivalent. Other than that, a fairly positive story. Opportunistic fixed income, the marks are more current through September. And that I think is more reflective of credit spreads tightening and high yield relative to where we are in opportunistic fixed income.
Steve, quick question just on the reporting aspect of things. So in our new asset allocation, we've moved everything in real estate kind of into one lump sum.
Yes.
Will we continue to see in future reporting breakouts that separate core and non-core opportunistic in real estate, or is it all going to just be
We
listed?
can do it either way. That's a really good question. We can do it. I prefer to see both.
Yeah, I think it would be.
Yeah, we'll be able to continue to provide you guys that breakout.
That's John Blusack.
Yeah.
And I'm sure Dan is nodding his head.
Thank you,
yes.
voice in the sky.
Thanks, John.
No, so actually, the real estate team is in the infirmary, so I got a bum knee, and Jackie's out with COVID. So we'll see you next year. But Janet is there to
Wow.
take care of everything for us.
All right, John.
Thanks,
Thank you.
John. Good night.
And the last slide in terms of the quarterly update, just to look at where we are from a rebalancing standpoint. So again, this is obviously we raised cash. You can see we raised $200 million, and that was for benefit payments for private market capital calls. You've heard that, we say that many times. But as equity sold off, bonds sold off bonds actually sold off more than equities, which is why we actually rebalanced. We sold equities and bought into fixed income. Again, to get closer to your target weights under the strategic asset allocation that moves in place. This is, yeah, it's just been around a little bit, but it's, I think Dan changed a little bit of the format and the coloring. And again, I'll talk more. So we actually had the new asset allocation targets incorporated for the preliminary performance review, which I'll do in an executive session. Great. But with that, any questions about anything I covered, didn't cover?
Yeah, quick question.
Sure.
How do you pick the benchmarks and how often do you change the benchmarks?
I think the benchmark should be reviewed, to be honest, and that's a project for 2024 for both private and public assets.
When was the last time they were reviewed?
It predates me. I've been here
17 months.
plus months, so yeah. Do you know?
I don't know the last time the benchmarks were reviewed, but the benchmarks are, tell me if I'm wrong, benchmarks are part of the IPS
Yes,
statement
they are.
and voted on by trustees. So it's not, BAM doesn't pick the benchmarks. BAM
Yeah.
would
Make
rank
recommendations.
recommendations and bring it to the trustees to assess and decide.
To be candid, I think that the benchmarks were probably determined on a more of a fundamental basis, meaning what we thought would make sense. And I'd like to put more of a quantitative rigor around how we analyze that, and really what the performance has been and what more tightly resembles performance of the underlying strategies relative to perhaps different benchmarks. But again, to Allison's point, you have decision rights on that. We would actually take a look at it and come back to the board. These are a few of the things that I've asked Chief Risk Officer Ed Berman to focus on expectancy.
I have a question just about defaults and delinquencies. So because there's always that fear that, one particular aspect of that, whether it's auto loans or something, is going to get to a point where the default rate gets so high that it becomes severely problematic for the economy. Do you see that happening in any particular sector there, or do you think it's just, all the money that people saved over COVID is now all spent and they realize they're in a hole?
I think the defaults, as a general matter, in terms of credit card defaults and auto loan defaults, even bond defaults, were at historical low levels. They're really compressed by COVID. I think what you're seeing is probably going back to something that's more normal. We'll continue to watch that. Defaults in high yield between 2% and 4% is typical, and that is impacted in the yield you get typically of the coupons that more than compensate for that. But it is something that bears watching, and it will have an impact on the economy as people fill up their credit cards. Their propensity to spend hopefully will be lower, and if not, you'll probably see that as an economic strain.
Thank you. Any more questions for Steve? Thank you, Steve. You did a lot of work into the report today. Much appreciated.
Thank you. Yeah, I enjoy doing this. This is what we do.
So thank your entire team, especially Dan Haas, for putting those
Dan-
slides
Dan
together.
Dan does a lot of work. Kate and her team as well in the headlines. So yeah, it takes a village, but Dan really does an outstanding job. So thank you for the
I
comment.
appreciate it. Very well done. Any more questions? Great, so this is the time, I guess I'll entertain a motion to go into executive session.
So moved.
Thank you. Is there, second?
Second.
Great. Questions? All those in favor of going into executive session, please say aye.
Aye.
Those opposed, say nay. Any abstentions? We are now in executive session. We are now in public session.
Thank you so much.
Tell us when we're ready.
There was an update on preliminary performance data. There was a real estate presentation, consensus was reached. There was a presentation on a private equity program, approval was given. There was an overview and update on a private equity partnership. And there were 2 infrastructure presentations in which consensus was reached on both.
Thank you, Ron. That's all for the public session. Do I hear a motion to adjourn?
So moved.
Is there a second?
Second.
It's been motioned and seconded. All those in favor of adjourning, say aye. Aye.
Aye.
Those opposed, say nay. Any abstentions? We are now adjourned. Thank you. And, I should have said happy holidays to everyone first before we adjourn. But I get